All right, we've got about 2 minutes before we get it started. If you're following along tonight, checking in the chat, love to give everyone a shout out who's joining us tonight. First shout out going to Tommy Lee in the Twitch chat. Happy 4th to you. Can't stick around, but no problem. Appreciate you checking in, joining us off the bat here. As always, these replays for our streams are going to be on our YouTube channel and our Twitch channel in case you either miss it or can't stick around for the whole thing. So no worries there. All right, there we go. We got Dashio. We've got Michael in the YouTube chat. I like it. I like it. Just over a minute left until we get going. And again, during these streams, we're going to have pretty much a running list of stuff we're going to go through. I like to have, the chat influence it as much as possible. So if you guys have any tickers or option plays or even situations that you guys personally are in that you would like some advice on or to have analyzed, let us know. We could throw it on the bottom of our list and we'll get to it. Sierra checking in the Twitch chat. Happy 4th of July. Coming in with the emojis. Prinzmeister in the Twitch chat too. How's it going? We've got some good stuff to talk about at the top of this one because we're in a couple interesting positions with between AHT and GTT. Those are going to be a couple interesting outcomes this week that we're gonna have to manage. Yeah, saying good weekend. It was too short. I will say the one thing that at least trading does for me is almost sometimes makes me wish the weekends were a little bit shorter because I'm always itching to get to Monday or Tuesday. KB in the YouTube chat, what's going on, man? 5, 4, 3, 2, 1. There we go. We are gonna click out of this and we are gonna get it started. So, happy 4th of July for those of you who are joining in from the United States. And for those of you who are not, I don't know, I guess I'll still wish you a happy 4th of July. But we got more for in the Twitch chat. How's it going, more for? But we're going to do what we always do. It's going to be a day late this week because we only had a 4-day trading week. So we're streaming Monday night. But we're going to do this how we always do it. Quick recap of last week, which ended up being kind of a rough week for us. I think about Wednesday, we were looking like we were about to break even, and then, for lack of a better term, shit kind of hit the fan for us on Thursday and Friday. But, that's okay. It happens sometimes. That's just the reality of trading. If we pop over to our year-to-date summary tab, you can see, if it comes up when I click it. There we go. A little bit of a downturn, but in the scheme of things, hopefully is just a little blip on a road to what was previously on pace for us to have a 3-digit % return on the year. With where we're sitting at right now, beginning of July, we still have half the year to go. That's definitely a mark that I want to try to hit because I think it would be super cool to say, we had 100% return this year, but important to stay disciplined and, keep our head down and not try to take some sort of shortcut in the market. So we will let that one play out how it does. But, point of us looking over here is to say, look, we didn't have the greatest week. But in the scheme of things, that happens. We have red weeks. We're not going to win every single week. The important thing is how we bounce back from it. So that is exactly what we are going to talk about after we quickly recap what happened last week. Up top, we had a $1,500 loss off UWMC December expiry 7.5 strike puts. And again, I'm not terribly worried about these December expiry 7.5 strike put. UWMC still trading above 8, and the break even on these is like 650. So that's what we kind of like about these longer dated puts that we were able to get into with UWMC. It's the fact that, as of last week, the week-to-week performance didn't look too great. But when you look at the trade in, the scheme of how it's going to work between now and December when those expire, if it stays flat from here, even drops another 50%, we're still going to hit max profits. So not remotely worried about that. ICLN, the most boring play in the world, is actually almost coming to an end here. We've got a break-even price of $23.53. We sold 24 calls that expire not this Friday, but next Friday. So if those finally get called away from us, we could pull that off of here, and that will wrap up probably the most boring trade we've ever made, but one where we were determined to break even. PSTH dropped a little bit on us, but the premium we got on the calls that we sold pretty much evened that out. Corsair, unfortunately, took a decent dive, dropping almost $2. We had 1,500 shares of that, but again, Our break even on that is roughly 31.60, so we're still above where we need to be to make profit overall on that one, despite a pretty big drop against us. And yeah, that's kind of the theme with a lot of the plays that we're making here. If we go over to that Corsair tab, if I could find it, right, you'll remember we started playing it at 38.50 back on June 14th, and in less than a month on us, it's dropped 16.7%, which is a huge number. Unfortunate that happened, but moral of the story is that the option selling strategies that we're putting in play here allow us to keep continually lowering that break-even price. And we're now at a point where 31.72 is our break-even price. Even though it's dropped almost 17% against us, if it just stays where it is at 32.07, we're going to make profit overall in the trade. While it's not going to be an enormous profit, the fact that we can still pull a 2.3% return on capital in a month on a stock that dropped almost 20% on us is, about as good of a value proposition as any. So that's why we're super happy to get in that play off the bat, and we're going to stick with it. We'll see what happens between now and July 16th, but so far that we are good to keep holding on to that one. SPX, this admittedly is where we probably made our biggest mistake on the week. These are hedges, so the idea is that if the market goes up as it did, we would lose money on these but make money overall. And the fact of the matter is we didn't have a ton of positions that were super highly correlated to the S&P 500 index. So this really didn't serve its proper purpose, and we started getting a little bit aggressive. The market kept running, and I'm going to pull it up right now really quickly if I can. With the Thinkorswim one. There we go. Yeah, so this is SPX, and as you can see, we are getting very stubborn. And this will hopefully just tie out this conversation really quickly because it does carry into what we're doing next week. But as you can see, it's very typical, even if the up and to the right, almost unrelentingly, you'll at least have it give back a little bit. And one of the best ways that we could determine when the market's going to give back is through RSI, which is the relative strength index. We talk about that a lot on our streams. Anything above 70 is below 30 is oversold, and historically, you can line these up. Last time it was oversold was on June 18th, and it bounced sharply from the bottom there. The last time it was overbought by this much, not a sharp drop off, but there was a little bit of a pullback and it leveled off. You could go back a little bit further to when it was oversold back in October of last year, and there was a huge rebound from there. But in general, it lines up pretty well and is, at least as far as we know, the best indicator out there to determine shorter term price movement and buying and selling pressure in the immediate future on a stock. And that's what we're seeing here, right? We have this run up where there really are no decent red candles, and we haven't seen anything like in a long time. It looks really similar, I think, if we back up to the 1 year chart. Yeah, to what happened last September roughly. RSI started to get to a pretty similar level. It's still a little bit lower, but at the very least, you see kind of a flattening out and just a nice run up with no red candles, and all of a sudden it fell off the face of the earth. And that's kind of what we're starting to see right here. Some green candles, not a lot of red in there. RSI once again. So we're thinking that it's going to pull back in the next week or two, but there's things where if we knew it was going to happen tomorrow, obviously we would go all in if it were a sure thing, but it's not a sure thing. We don't know what's going to happen. So what we do is we set ourselves up with credit spreads. And for this week, this red line right here is what we need to keep it below by Wednesday. So we're going to have 2 trading days for this thing to stay below this red line. So that'll be something we're keeping an eye on. But if you back it up to the 10-day chart here, we kept playing it to stay below, this level, and kept having to roll these up. And that is what happened when you take a look at these call spreads that we sold. So the biggest mistake that we had here, I think, is our original expiry was June 30th. And you can see June 30th right here on the chart. So what we needed was for it to stay below 4,300. It broke through 4,300. And these actually would have finished for max profit. But, right here on the day before, on the 29th, they got pretty close. And we never want to play those because you could see what we got out for a $20 gain. Could have potentially been it could have been a $3,500 loss. So that's not something we want to risk in the short term. So we were happy to roll that to 43.20, which was right here. And the expiry on that was July, which is this see right here in this column, and it blew right through that. I mean, the movement that we've seen lately in the market is incredibly bullish. It's very overbought by the indicators, but that is what told us to keep these things rolling. And then we rolled again to 4340, which is up here, and it blew through that the same day. So there was another one of those situations where we don't want to test it again. We rolled up again, expiry Wednesday, to this red line. Biggest mistake that we made, right, is the fact that, look, all in all, we lost $3,700 on this. And I think if we, kept the first one, and if it were max profit, it would have been a $3,500 loss, right? So what we did up front was we tried to cut these loose to prevent ourselves from taking a max loss. But by rolling these up, we basically took more than what our original max loss was. And that hurt a bit and is tough. But, I like the idea of rolling when the short leg on your spread gets tested. What I think we did wrong was roll too short term to 7.2 instead of giving ourselves a chance to wait for that pullback. We rolled from this day to this day, which really isn't that much time in the market, right? If you zoom this thing out to the 180 day, you want to give yourself a little more time to catch these downturns, because the market's never going to go up and to the right in a straight line, even though that's almost exactly what it's looked like over the past couple weeks. Give yourself a few days to at least let that thesis come true. So that was our biggest mistake. And I think moving forward with these, what we're going to do is look to, we're still going to look to roll, but we're going to pick a further expiry than just rolling from June 30th to 2 days later on July 2nd. So, hand up, mistake there, and that fueled a little bit of these losses. But, that's what happened to us right there. ORPH, moving down the list here, is a play that we had on a biotech stock that was already past FDA trials and almost seemed like a home run, and so far has been a home run for us. That one's working out really well. BBIG is, working out okay. I think it's roughly break even right now because the price on the option. Actually, I think this is one. Yeah, I forgot to update it the prior week, so some of these option prices carried over because I forgot to update some of them. So this week, even though it looked bad, we lost $6,800. It isn't that bad because we had $2,000 that we made back from not updating this properly. But point of the story, BBIG is about even. ASTS is one we had in. We forgot to update that as well. It's down to 0.85. We sold it for 1.3. And that one, I want to bring this chart up really quickly because this is a strategy that I think we can try to pull off a little bit more. Green candle here, right? We're going to zoom in. It was trading at about $10 a share, and then some news came out that Goldman Sachs initiated coverage on this stock with the price target of, I think, $30-something, which is incredibly bullish news when such a big bank invests in the company and, puts their name behind a report saying, hey, we've got a price target of $30-something on this. So as you could see, the price spiked up from 10 to like an intraday high of almost $15.50. But where does our strategy come into this? So what happened is, when a stock moves up this quickly, we could pop the implied volatility study on here to illustrate what we're talking about. Volatility. There you go. When it spikes up this much, you get a spike in implied volatility that inevitably kind of levels back off. But when we get this spike right here, that's exactly what we want, because that spike in implied volatility is a spike in the premiums and the options, which means we can sell options for inflated premiums, and we'll be able to collect a lot more profit on those up front. So what happened was we were in a situation where, we saw this Goldman news came out. They're an investment bank that has put far more research into this stock than we could possibly do in the time that we have to research. We already know that it's jumped up to $14, $15, and we had the opportunity to sell a 12.5 strike put for $1.30, expiring July 16th. So in 9 trading days from now, which would have been, I think, 11 or 12 trading days from the time that we opened. But the logic behind that, right, is we know when we sell a 12.5 strike put for $1.30 of premium, that gives us an $11.20 break-even price. So what we were looking at was a stock here that, when we were looking at it, was trading at 13 something, 13.50 maybe. We knew that there was good news behind the stock. We knew that we could sell a 12.5 strike put and have a where our max profit is at this level. And on top of that, we'd get $1.20 a premium, meaning that our break-even price is at this level down here. So I really liked the value proposition there. It looks like it's leveled out at about 13.25. So as you can see, the implied volatility has dropped off a little bit. The puts that we sold for $1.20 are now down to I think, what is it? A dollar, excuse me, they're down to 85 cents. So we're, almost at 50% of max profit on there, but we've pulled a quick $450 off the back end of the week just by identifying a setup like that where there's this spike in implied volatility, which creates this spike in premium. Kind of adding on to that conversation, CERE was another one where we did, the same exact thing. So CERE was this biotech stock. Same setup you'll see on the chart, right? Is the fact that it was trading around 15, 16, was down at 12 before the out. But they had some really positive news. Spiked up to about $27 when we were looking at it. And we said, hey, take a look at the implied volatility. The implied volatility has gone through the roof here. So we said, what kind of opportunity is that given us as far as option selling is concerned? And we found a play where same expiry as ASTS, we were able to sell a 15 strike put for 44 cents a premium. So we know, again, our max profit level is at that $15 level. So as long as it stays above here, we'd hit max profit on the trade. And that's a great value proposition because, one, it was pretty much trading around this level, for most of the last 180 days. I mean, this right here that you're looking at is the beginning of December 2020. So it's spent a decent amount of time in this price range. And when we were looking at it, it was up near 27, 28. So we knew this thing could drop almost, 50% on us and we would still be okay in the scheme of things. So we were looking at a stock, again, like we mentioned, was trading in this range, got good news. So, if a stock trades in this range and gets good news, obviously it's going to be worth more. So the fact that we were able to set ourselves up with the play where our max profit level is theoretically below where, the new value of the stock is, no matter how high it spikes or falls after the spike, it doesn't matter because we sold 15 strike puts. But the fact that we were able to do that, and we had such a low buying power requirement on these as well. I don't know if I broke this out into no, I don't think I did. Let me check the trade performance tab here to tell you exactly how low of a buying power requirement it was. And I have not updated this either. All right, getting a little bit lazy. But, point here is that we were able to sell these super far out of the money puts. These are super high percentage, and we were able to get a really nice return on the amount of collateral that they required. I think it was something in the neighborhood of 10 to 15, maybe 20% return on collateral there off a super, super high percentage play. And while we did get in at 27 and it's since pulled back to 23.02, we don't really care. We didn't want the stock to go down, but it's still gone down. But because the implied volatility has dropped off so much, these options are now worth half of what we sold them for. So we've already made a quick $500 just off those. So that was another awesome play. And we're looking to target more of those moving forward. ALEC is one that popped up this week as well. Another biotech company had some good news. You'll see that similar setup, a super big spike. And, a lot of these you'll see people talking about stocks like this on social media after they blow up and say, hey, what do we do here? Because people are trying to either buy or sell the stock. So they're debating chasing it at 35, which is, a terrible place to get in on a stock like this. So with option selling strategies that we employ, like we just talked about with CERE, like we just talked about with ASTS, we're able to set up a play where our break-even price is, or our max profit point, is below where it was previously trading, right? We were able to sell 20 strike puts expiring in August. So our max profit point, if I can click here properly, is right at $20 a share, which is below where it was previously trading. They got good news, so theoretically the stock should be worth decently more than this. So even though it's spiked up a bunch and might pull back, I don't even care if it pulls back. As long as it stays above 20, that's all I care about. But, you would have to think that a stock that traded here, then got good news, even if it did pull back, it wouldn't finish below where it originally started. So that's why we've got this set up with an August expiry, super high percentage play on that one. So that's another one off that similar strategy that we talked about with CERE, with ASTS, where you see these big spikes on the stock due to good news. And I think, I think that's an important distinction to make too, because if you see spikes like this that are just, short squeezes or something like that, they're going to come back down. But what we like to look for with at least this strategy that we've started using a little bit, are spikes that are based off of good news for the company. Shout out to Stuberlicious for the follow right there. Appreciate it. Will House in the Twitch chat checking in. What's going on? But, just recapping, ALEC, ASTS, CERE. These are three of the very similar plays with a new strategy that we're starting to put into play a little bit, where we chase a big spike off good news, which means that, with that good news factored in, it's going to be worth more than it was before. And then spikes and implied volatility, you're going to be able to sell puts with a max profit point below where it previously traded. So you put yourself in a very, very, very high probability, safe and profitable position right there. Those are kind of the three things that we're gunning for with this. So very happy with how those turned out. I might try to maybe assign some sort of a name to this strategy so we can track it a little better, and you guys will know what I'm talking about when I call it out. But the way these have set up and the success we've had with them so far make them something that I definitely want to keep an eye on going forward. But that is just about it for the recap, except for the two stocks that I got to talk about really quickly, and I'm sure some of you in here are very interested to hear me talk about, which are going to be AHT and GTT. So as you can see from this little note right here, we closed half of GTT, and I'm pretty happy that we did that because we reduced our potential loss on that by closing that position down a little bit. We're down to 25 of those left. But what happened with GTT was the stock last week was delisted, unfortunately. But, I don't think that's too bad of a thing for us here. So what's going to happen is the number one question, right? So the stock gets delisted. Tomorrow, they're going to begin trading under the ticker GTTN on the OTC market. So all these options we have, nothing is going to change about this trade whatsoever, except this is going to have a little N on the end of it. Options get carried over. The stock price gets carried over. All that good stuff gets carried over. So you don't have to worry about any of that potentially affecting your trade. The only thing that could potentially affect it a little bit, is what happens Tuesday at open, how investors interpret this news. So if they say, okay, the stock got delisted, that's terrifying, we're going to sell, and it drops to like $1, that's going to suck. But the position that we have, we've kept it relatively small. Even if our two strike puts drop to $1, we know that those are going to be worth $1 because two strike minus the dollar strike price means that these are going to have $1 of intrinsic value. The two strike puts are going to be worth $1. And we'll have lost, a couple $1,000s, which obviously it's never fun to lose a couple $1,000s on a trade. But, when the alternative is the potential for the stock to completely fall out of the sky and you've got this terrible situation where your stock gets delisted out of thin air almost, walking away with the $2,000 loss on something like that isn't the worst thing in the world. And that's why we diversify our plays. We keep these, quote unquote, riskier plays. We keep the position sizing a little bit smaller so that when something like this does happen, we're prepared and we can handle the loss or any potential loss that we might see. So with that in mind, there's no reason that this thing opens tomorrow and it can't shoot back up or stay perfectly flat or stay above 2. So delisting isn't death for a stock, right? The one big risk that we identified with GTT was them potentially filing for bankruptcy, and they haven't done that yet. So them getting delisted doesn't do anything to the actual value of the company itself, right? Bankruptcy could potentially impact that, but getting delisted doesn't. And that's why I'm perfectly happy to just keep holding on to this and let this thing shake out how it will. So, best case scenario, obviously, this thing stays above 2. These expire worthless, and we're sitting on a $500 gain, and we never have to look at this thing again. But, it's always important to look at the downside, see what the worst case scenario is. So that's something that could potentially happen. Worst case scenario, somehow it goes to 0, which technically is impossible, and we lose $4,000. But for now, we're going to be sticking with it. We'll evaluate again on July 16th to see what's happening there. But this one I'm not terribly worried about. I will say number one on my list of worries for this upcoming week is going to be AHT. And we've already booked a lot of this loss in last week. So the stock loss isn't going to hurt us too bad for this upcoming week. But here's what happened with AHT. Everything was, we sold these 5 strike calls. I think it was our break-even price was $4.16. So our break-even price was down here. We were okay with that. But what happened is right after the market closed on Friday, they announced a 10-for-1 reverse split and that they're potentially diluting the stock a little bit by issuing some extra shares. So this is something where fundamentally, conditions have changed. They're issuing a reverse split. The float might change a little bit because they're going to, sell some additional shares. Things have changed a little bit on this from when we initially got in. We looked at the 180-day chart off the bat, right? You've seen it bounce off 225 multiple times. You've seen it trade in this 4 to 250 range. And that was something we expected to continue, at least in the short term, a little bit, so we could sell calls on that and continue to drive that basis down from 416. But, this big of a drop prevents us from doing that. So we're definitely staring a loser straight in the eyes on this one. The important thing here, right, is that, again, we kept our position small. We only have 1,000 shares. So even if something crazy happens, this goes to zero, we're losing $3,000. So, not the worst thing in the world. What's going on, Trader Cliffo? Welcome to the Twitch chat. Appreciate the follow. And again, thank you to everyone who is joining in tonight to watch us explain how we are going to try to weasel our way out of this AHT position without too much damage. So if I flip over, I think I've at least gotten this one broken out. There we go. So I've gotten this one broken out. We bought 1,000 shares at 451. Those have dropped a bunch. We sold 5 strike calls. Those got our break even down to 411. This thing unfortunately hasn't updated yet because the drop occurred after hours. So it's down to 289 is what we're going to be looking at. So overall, we're going to be staring at what should be a $1,000 something loss if this thing updates. Come on. We've got the loading bar right there. There we go. A $1,200 loss, which not the worst thing in the world, right? We kept the play small. We kept a lower amount of capital invested relative to our entire portfolio. So a big downswing isn't going to hurt us too badly. But what we can do is be focused on, how could we potentially save this? So the first thing that we're going to look to do is, one, do we want to stay in this position? Facts have changed. Things have changed a little bit. Is this something that we want to stick with? And I think the most important thing that I could point out, which scares me away a little bit, is about a year ago, they did a reverse split as well. So I might back out a little bit further on the 3-year chart, but it was last July, which is right around here. There we go. You can see they got a 1-to-10 reverse split. They did the same thing. On the day of the split, the stocks shot up a little bit, but over the next, 5 or 6 months, it went from, $6 down to about $1.76. So they're about to do another 10-to-1 reverse split, which is going to take the stock price to about $28, $29. So the question now is, what do we think is going to happen after that? And it's tough because, in theory, a split doesn't affect the actual value of the company or the valuation of the stock. But I think in practice, psychologically with traders, it does scare them off a little bit when you have this stock that they were previously playing that was trading for $3 or $4 a share, because you perceive your downside to be a little bit less as opposed to when you're playing a stock that's trading at 28 or $29. That's just the way the trading psychology works, and that's just kind of how it plays out sometimes, even though that type of thought process is not necessarily based too far in reality. But that's the way it is, so that's the way that we're going to have to address it and handle it moving forward. So it does scare me a little bit. I think when we talk about the H2 wheel, right, when we enter into trades, we only want to use 50 to 75% of the capital that we're fully comfortable in the player. So this thing drops, and if we had invented, excuse me, I'm already starting to go off the rails here. If we had invested 100% of the capital that we were comfortable putting in AHT up front, we kind of would have been SOL right here when it dropped down. We wouldn't have any way to continue to lower our break-even price. But what we could potentially do tomorrow when the market opens, sell a bunch of these 2-point strike puts, and I say a bunch, probably just 10 of them to increase the position to make it a full 100% of the capital. We're trading for pretty much nothing before the market closed on Friday, but that is definitely going to change after this big of a drop to get it down to the 290 level. Talk about implied volatility on such a big drop, that's going to jump up. The fact that the price is moving down closer to 250 is going to make the price of those 2.5 strike puts jump up. So this is going to be the way to do it, right? because we have two options. We could buy more shares, which means we'd be getting the shares at roughly 289. So I mean, let's see this thought process through, right? If we wanted to buy 1,000 more AHT shares at 289, here we go. We know that that would take our break-even price if we copy this formula down here. It was previously at 411. I kind of just mess with this sometimes to see where it goes. There we go. We nailed it on the money. It would take us down to a 350 break-even price, which is a lot more manageable for the trade, right? Our break-even price would now be here when we started up here, and that's just in the short week that we've been involved in this trade. So that's one option where we have the shares with the 289 basis. The second option is instead of buying the shares, we could just sell puts, and it's going to be tough to guess how much these are going for. I think if I had to guess, maybe 15 or 20 cents of premium is what we're going to be able to target upon open on Tuesday, tomorrow morning. So conversely, we could do that where instead we'll sell 10 AHT 716 2.5 strike puts, and we would sell those for 20 cents a pop. Again, we're just guessing right there. We're going to have to drag a new formula down, but that would give us $200. So our break-even price wouldn't be down to 350. Our break-even price would be this 411, I think, minus the 20 cents of premium. So it should be 389. Excuse me, nice math right there. Should be 391. Perfect. That zeroes us out. So selling the 2.5 strike puts would give us a slightly higher break-even price. So you might be wondering, hey, why would we want a 391 break-even price as opposed to just buying the shares and getting a 350 break-even price? And the answer is because if we're assigned on these 250 shares, it's the 250 puts, excuse me, it's the equivalent of buying those shares for what would be $2.30 a pop, which is much better than the 289 that we would be able to get right now. So if we were eventually assigned on these, right, we would get 1,000 shares, AHT shares, and we would get those at 250 as the basis on those. Again, we're not going to put the adjusted basis in here because this is factored into this line right here. If we were assigned, we would then have the shares, and those would be trading for whatever price we throw up here again. And our new break-even price, instead of the 350 that we had before, right, you'd be at a profit at 350. Our new break-even price would be, I don't know, maybe 3.2, pretty close, 3.21. Okay, between 3.2 and 3.21. So the idea here, right, is that we, instead of, just jumping up front and buying the shares for 289 and getting that break-even price to 350, which seems like a decent break-even price, we could sell 2.5 strike puts and put ourselves in a situation where, we always want to protect that downside in case things move further against us. So by selling the 2.5 strike puts here, potentially, if it moves further against us, we could then take assignment of those shares with the 230 adjusted basis, and we now have a 320 break-even price. And let me plot these on here quickly. This would be our break-even price if assigned on the 2.5 strike puts. Wanted to get crazy off the bat and just go right after the shares. Our break-even price would be, here we go, 350. And then our current break-even price is 411 right here. So there are options really when we double down. And this is a great way to visualize how effective, kind of doubling down and allocating more capital to a play is with the strategy. And that's why we emphasize position sizing so much. Because while our initial break-even price was here and we entered the trade, I think maybe on this day, it's dropped this far against us, but we now have some more recourse where we could go from our original break-even price of 411 down to either 350 or 320, depending on what we do from here. And Dasha, yeah, those 5 strike that we sold would be worthless tomorrow, and you're correct. And we can't really sell those, like you mentioned, or we can't roll them rather. The next strike is 2.5, which kind of sucks. Whereas with another play that we got, BBIG, the reason I particularly like this one is because you've got a lot of flexibility for strikes. The issue with AHT is going to be that, you can't roll down from a 5 strike to a 4 strike. You're going to have to roll down from a 5 to a 2.5. Now, what could be interesting is if we roll down to a 2.5 and just say, hey, I just want to get rid of these shares, depending on the amount of extrinsic value on these 2.5 strike calls come Tuesday morning, you might be able to lower that break-even price even further. As long as the extrinsic value on the 2.5s is greater than the 5s that you're foregoing, nice pronunciation there again, as long as the extrinsic value on the 5s is less than the extrinsic value on the 2.5s that you are selling, you are going to be able to lower that break-even price further. So on the first set, right, your break-even price could get down to like $4 or something, and then you further lower that. But again, a great thing to mention, right, rolling those calls, because there are so many different ways that we could play defense on a play like this. And this is the value in our strategy, right? So often people will get FOMO. They'll see a chart like this where we'll get in, even like SOL the other day is one we could point out, right? We got in right around here at the 780 mark, and we sold 7.5 strike puts, which means as long as the stock finished above here, we were going to be okay. Now, in the subsequent days, the thing ran up like 30%, which is, great for us because we're going to make some largely stress-free profits on this 7.5 strike puts we sold. But sometimes people who are playing the strategy can get a little impatient and say, okay, this stock just ran up 30%, but I only took home 5 or 6% during the week. And FOMO, yeah, for those of you who don't, fear of missing out, FOMO. So when you see stuff like this in your options, right, we take a consistent, conservative, and I think educated approach to our option selling, right? We want smaller gains that compound over time. So we would sell 7.5 strike puts to target that smaller gain that we would like to compound. But again, it's a higher percentage gain. But sometimes people get impatient saying, oh, I sold a 7.5 strike put on a stock that ran up 30%. This sucks. I should have made 30%, blah, blah, blah. The reason why we do what we do is exactly this situation right here. Not so much because we want to miss out on huge upside if the stock runs up, but because if the stock runs up, we're going to make money regardless. That's quote unquote, that's our risk. And the fact of the matter with the strategy is that if that comes into play and our risk is that we could have made more money, and the risk that we realize is that we made money at all, pretty good trade-off when the risk that you realize results in you making money. So again, this is all designed around protecting yourself off potential downside on the stock. And Emmett Taylor in the YouTube chat, question about what we think about VISL. I will throw that on the list and I will talk about that shortly. I'll try to wrap up quickly here on this little AHT spiel, but I know a lot of people who are following along in our Discord and maybe who are watching along tonight are in a similar position. And it's one of those things where objectively, I'll be the first to tell you, having a stock drop 30% after hours before a holiday weekend, it sucks. It is terrible, and it is not fun to watch your account balance go down. But the good news is that we played it and have been following along with the strategies that we implement in the market. You're going to be okay. Will you maybe take a loss on this play? Yes. But sometimes when a stock drops 30 to 40% on you in a short time frame, you're going to have to take a loss. That's just how it works. The idea is that we do this on stocks that we would have been comfortable holding long-term anyways. And, I still stand by the fact that I would have been okay holding this a little bit longer term. It's a hospitality, hotel-related portfolio company. What they do, it's a big reopening stock, right? Because once people are going to be able to get back into hotels, this company's getting a lot more cash flow, and they'll hopefully be able to pull themselves off these lows. And while facts did change a little bit with this reverse split, at the very least, I'm willing to increase my position to that initial 100% allocation by selling 2.5 strike puts tomorrow and then getting myself down to a point where, come July 16th when all the fire, we'll take a look at the strikes on the options, we'll take a look at the premium, and then we'll evaluate our position. It's very, very, very likely that come July 16th, we're going to be staring at a loss, but it's also very, very important that you evaluate each of your positions on a day-by-day, week-by-week, month-by-month basis. Just because I'm sitting here with like maybe what would be a $1,000 loss on AHT, and it's July 16th, I might say, oh, well, I can get a little bit aggressive here, and between July and August, I can sell enough premium to save that play. I don't like the stock, but I could, numbers-wise, maybe save the play. If we don't like the stock anymore and don't like the setup, we don't need to get stubborn and try to, be dead set on turning a loser into a winner. We can just take that money off the table, accept the fact that it was a loss, and move on to the next one. Losses happen, but in our strategy, as you could see, and as we have demonstrated throughout the past year, they're not very often. We have a 79 win to 8 loss ratio. Where are these losses coming in? Etsy's one right there. But ICLN is one we're about to turn around, so we're going to have one less loser. PSTH is one that's turned around. So I think we've got pretty much 7 losers that we've locked in over the life of the tracking that we've had on here publicly, which goes back to November of last year. So these are high percentage plays, important. You can see some of these losses are decent losses, right? We locked in some big losses on CLOV, VGAC, but we just got to a point where we weren't happy with the value proposition on those stocks anymore. And that's a perfectly okay conclusion to come to. So with that in mind, we will continue this AHT play until July 16th. We're going to sell more 2.5 strike puts come Tuesday morning, depending on what we see. And then we will reevaluate in a couple weeks. We're very, very likely to be sitting on a loss. Whether or not we want to lock that loss in or make it back, we'll revisit that in a couple weeks. But, moral of the story here is we're not dead in the water. It's okay that a stock dropped this far on us. We're going to live, right? Because we conceivably could maybe see a bounce off this lower support that we drew before back up to this 350 level, which would get us right to where our break-even price would be. So, it's a waiting game. It's a patient game, but it's a game that we've played a lot, and I know that some of you who are following have also started to play a lot. So you'll start to get used to having these big moves against you, and then eventually you will get comfortable with these rebounds. And after a play or two turns around for you, if this turns back around for us, this would be the perfect example of something like that. But it gets a lot easier to hold on to these and be patient, especially one, when there's smaller plays in your portfolio, and two, when you have the experience of having played multiple of these. Got KB in the YouTube chat asking about MUPLTR. Definitely going to take a look at both of those for you. Let me write those down. All right, we're going to talk about VISL now. Then we're going to talk about SoFi, which is one of our first option buying plays that we have had in the last year. So I'm super excited to talk about that one and what we were seeing right there. But we'll get into VISL really quickly. But before that, I'm going to take a quick sip of water and we will get right back into it. Gotta be honest, ice water is incredible when you have been talking for 45 minutes straight. But let's get into it. VIS, here we go. Visalink, and this is one we've talked about a little bit in our Discord server because, as you can see, super wide price range, a lot of volatility, things moving up, things moving down. Recently, there's a little bit of a spike in volatility as it jumped up from, the 2.7 level, just above $3 a share again. Emmett in the YouTube chat, if you've got any context or anything you'd like to add that is going on with the stock, or if there's any reason that it caught your attention, feel free to throw that in the chat and I can address it and add it to our conversation here. But we're going to take a look at the news really quickly to see if anything has come across. There we go. They've joined the Russell Microcap Index as of 6:30. That's good news. I don't know if that's necessarily what caused this because 6:30 is right here. 7-1 is right here. One of these 2 days is when all the index fund buying would have had to take place. So not the catalyst for what we see here, but either way, sometimes when a stock looks like this, and we zoom back out to the 180 day again, sometimes when a stock looks like this, there doesn't necessarily need to be a catalyst to make something move 20 or 30% in a day. But we'll go back into that 10-day chart and we'll take a look at the option chain that we've got right here, because I'll seem to recall they've got some decent premiums, right? So for July 16th, off the bat, this already looks like a pretty decent play from an option selling perspective. And we've got Emmett adding that he heard there's a lot of hype talking about a breakout should be happening soon. And that definitely is what this chart would look like, right? If we look maybe at the 20-day here, some resistance in this $3 area. So if we're able to break above that and hold that for a little bit, we definitely could see a breakout. Question is to, where. It doesn't look like there's too much precedent for a breakout above 3. Maybe back in this 350 range is where it could touch. But with that in mind, let's take a look back at the option chain. This is actually a really, really decent opportunity right here, right? A 5.26% return in what would be 9 trading days on 2.5 strike puts. So if you wanted to be decently conservative and set yourself up with a play where the break even is so low that we have to zoom out, the break even would be at 240 right here, or between 240 and 235, depending on the fill that you get if you got 10% or 15 cents. But that would be a super conservative play. Your max profit point would be right here, and you would pull a 5.26% return on the amount at risk in just 9 trading days, which is phenomenal. I really love the value right there on this 2.5 strike puts. One thing that we also like to talk about is potential leverage that your broker offers. There we go, talking myself in knots again. Normally we know that if we wanted to sell a 2.5 strike put, it would take $250 of collateral, because that's the amount of money that it would take to buy 100 shares at $250. But let's see what the broker requires. Yeah, it looks like so max loss would be $240, but they only require $160. So you get about 33% buying power leverage right there. Not too bad, but we know that if we sold these for 10 divided by 240, let me pull up the handy dandy calculator on screen here. So previously, 10 divided by the original 240 would be 4.1% return on capital at risk. But if we were able to do, use some of that leverage that our broker offers us, it would be a $10 of profit for only 160 in buying power, which bumps you up a little bit to a 6.2% return on capital over the next, 2 weeks, which is a great number. Do not want to minimize that one bit. Even though sometimes the numbers here look small, you might just need to bump up the contracts a little bit to give you something that might make you excited about the trade. If you wanted to sell 50 of them to get $500 in the next 2 weeks, it'd cost $8,000 of collateral, but that would, start to get you a little bit more cash, some bigger numbers than just 10. But again, a lot of the time we get questions about, hey, I've got a smaller account, what should I go for here? Perfect example, because this requires less than $200 if your broker gives you a little bit of slack in the margin department. But even if they don't, it still requires less than $250 to enter. So I really like this play. That's something I want to flag for those of, I guess, if I do get that question again this week about what we could do with smaller accounts, this is a great recommendation for that. So appreciate you putting that one in the chat, Emmett. One other thing I want to mention here as well. We talk about, should I start a play with cash secured puts or should I go in on calls? There's never really, I guess I should say 99% of the time, I feel like it's better to start with cash secured puts. You've got a lower entry. If things move against you, you're going to have a nice break-even price to start a potential trade with. However, what we see here is what's called a little bit of call, right? So these are pretty much at the money. Or they're 50 cents out of the money. So they're between 10 and 15 cents. These are $2 out of the money, right? So these are 50 cents out of the money. These are $2 out of the money at a 5 strike, which is 4 times the distance out of the money. Yet the premium is more. Typically, when you look at an option, the closer it is to being in the money, the more that it's worth. So as you can see, 79 cents, the closer you move to the money, the more it's worth. The closer you move to the money, the more it's worth. And these are pretty much at the money right here, the 140s. They pretty much the same exact option on the put and the call side. These are trading for $139.96. But point being here, at the similar strike, $1.17 a premium, $1.20 a premium, basically the same thing. So that's what you'll typically see. With VisiLink, again, 50 cents out of the money is 10 to 15 cents, but $2 out of the money is even more. So that's a lot of value. There's a pretty big call skew here, which indicates that there's some upward buying pressure on the stock. So if you wanted to get a little bit riskier but increase the potential reward on that, rather than going in with the 2.5 strike put, you could buy some calls. And let me model this out really quickly in the old potential trades tab that we've gotten here, because I think this is a great way to illustrate this. If we put VISL, start date would be what? Tomorrow, 7/6. 7/6/21. End date would be 7/16 again. And we know these are trading for what? $3 after market. Started at $3. If we wanted to buy 1,000 shares of VISL, we'd be able to get those for $3. And we would sell 10 covered calls, right? So this would be the alternative to selling cash secured puts. We would jump in on shares, and then we would sell 7/16 5 strike calls. And thanks to the skew, instead of the 10 to 15 cents of premium that we would get on the 10 to 15 cents of premium that we would get on the 2.5 strike puts, we get 15 to 20 on the 5 strike calls. So we're getting more premium up front. So we'll be conservative and call it 15. Now, the difference here is your break even is going to be a little bit higher. Your break even on these is going to be the price you get them at minus 15 cents. Your break even is going to be 285. That's what will zero you out on the trade. So that puts you right up here for a break even price if you're taking what we'll call the aggressive option, right? So that's the sacrifice, the cushion that you get on the trade. However, the upside here is undeniable, right? When we talked about those 2.5 strike puts, you're getting a 6% return on capital, 4% return on risk. Now, higher percentage of higher probability of profit on those. But you could really hit one out of the park here, because if this runs up to $5 and you get these called away and we see a crazy breakout, you're now making the collateral on here is wrong as well. So that would take 3,000 of collateral. That would take 285 your break-even price times 100. Times 1,000. So that's how many shares we'd have. It'd be 2,850 of collateral. So what this would do, if you were able to knock it out of the park, right, and VISL shot back up to 5+. Oops, did not mean to do that. That is gonna lock me out of this for a demand. But going back to our spreadsheet here, the point is, if it shot back up to 5, you stand to make $2,000 on the profit, as opposed to only getting a small premium. So I really like the potential for playing this 5-strike call, because that gives you a decent shot at hitting a home run. Right? Sometimes it could get a little in these strategies we do, because if we just sold the puts, we'd be chasing that $100 of premium, sitting back and waiting. But if you did something like this, be able to chase this home run play, where if VISL all of a sudden to 5, you're now sitting on a lot of profit, even if it just shot up to like 50, that range that we were looking at. And I probably should update that by updating this cell. You're still looking at a 22.8% return. And if it stays flat, all you're going to collect is that premium of 5.26% return. So you get a little more premium up front. The only issue here, right, is if it drops down to 2.5 in a situation. Puts, get me out of on-demand. Out of on-demand. Boy, I think you're up on me a little bit. But point being, we know we had that original break-even price where we would have made $100 on the 2.5 strike puts we sell. If it drops down to 2.5 with the covered calls, you're losing $350 in the situation. But with the potential upside of running up to $4 or $5, that might be very well worth it to you. And that's kind of the game we play, right? Choosing where you want to put your break-even price, what risk versus reward that you want to take on. And with this, while I am always partial to selling puts and getting into the lower break-even price in case things move against us, like we saw with AHT, I don't hate the idea of jumping in on shares off the bat on this one. So I would definitely give the green light there. We've got a question right there in the Twitch chat from Prinsmeister. We've got, let's see. Would we go ahead and sell the puts for it too? So I wouldn't sell puts off the bat for this one, right? Selling puts, like we talked about with AHT, what might be the plan for tomorrow, where we sell the 2.5 strike puts to try to rescue that play. I think selling puts is, if you wanted to start off this play doing cash secured puts, that's perfectly valid. Chasing that 6% return in 2 weeks is awesome. But if you were to take the covered call route, you would not want to write puts off the bat. You wouldn't want to write puts until the stock starts trading on you. And then you could sell those puts to lower your basis and potentially take assignment of stock at an even lower price. So that is when we would look to enter into those. So you've got two options. You either sell cash secured puts up front, let those ride at 2.5 strike, or you take the covered call route. And then if it drops by July 16th, that's when you would leg in to some, oh, there we go. I got out of the on-demand screen so I can look at this again. That's when you would leg into the 2.5 puts. And the great part about these, right, is sometimes you can get so caught up in looking at what's happening for July 16th. We see, we've got a little bit of premium here. I would have a break-even price of $285. You'd have that break-even price $285 moving into August, where you could then sell 5-strike calls again, and those things are going for 35 to 40 cents a piece today, and there's a ton of volume on those. So with that in mind, you'd be able to lower your break-even price from $285. We'll be conservative here. We'll call it 35 cents. So you would lower your break-even price from 285 minus 0.35. It gets you down to a 250 break-even price come August 20th when those expire. Or if you wanted to take the cash secured put route, instead of going short term to July, you could bite off a little bit more premium by moving forward to August, right? You can get between 30 and 45 depending on the fill. If you were able to get 35, I think that's a decent opportunity right there. You'd be getting 350 off $1,600 of collateral if you're going to sell 10 of those. So still a decent return, right? Even full, if you had to sell those fully cash secured, that's a 18% return on capital risk. So that's a super nice play. But we always want to think of these as kind of 2 or 3 steps ahead of where we're currently at. I know that if I did the covered calls, my break even would be 285, but I'm okay with the 285 because come July 16th, 9 trading days from now, I'll be able to roll into 5 strike calls for August and then continue to knock that break even price down month after month after month. And presumably the Septembers will be added come August, and then you could knock your break even price down another, chunk of cents. And as I say so often on these, the idea is we could lower our break-even price forever. The stock can't go down forever. So the idea is eventually one will catch up to the other and we'll finally find ourselves sitting on some profit. But that's kind of the idea behind looking a month, 2 months, 3 months down the road, potentially plotting that price and seeing where you would be off the bat and then where you could go from there. So I really like the Visualing play. I think especially, I feel like I'm maybe talking in circles here by saying this, but with those smaller accounts, if you do want to play, you could get in for $100 or $200, or you're saying, hey, I've got $500, I've got $1,000 in my account, and I want to learn, how to run these HT wheel strategies and learn all these option selling strategies. This right here is example A of what you should be looking into doing. So appreciate the suggestion, Emmett. I'm glad we took a look at that one because I think that's a really nice setup for us. So now we're going to take a look at SoFi, SOFI, and we're going to talk about this one. No, not SoFi, IPOF. I wrote down the wrong ticker in my notes. But we're going to take a look at IPOF, and we love this one because it's our first option buying play in about a year. And if I go back to my tracker, I don't think I really knew what color to make it when I labeled my plays for the week. So it's our first purple labeled play that we have in our profit tracker. So IPOF, we bought 25 September 17th 10 strike calls for 41 cents a pop. So knowing what we know about options, what does that mean? So where it stands right now at 10.20, if it doesn't move between now and September, these are going to be worth 20 cents. We're going to take a $500 loss, whatever. Over the course of the next 2.5 months, I think we are okay with absorbing that kind of a loss. But what we like about this one with option buying is, a rush that we haven't felt in a decent amount of time is the fact that we've got potential for infinite upside and profit on this one. So if something crazy happens and this runs back up to like $18, these are going to be worth $8 a contract. And all of a sudden we're sitting on a $19,000 gain on a play where we had a max loss of like, $1,000. So, it's almost like we're placing a bet where we bet $1,000 but have potential upside for almost 20 grand on the play. J Mart's in the YouTube chat. What's going on, man? Appreciate you popping in. We are talking about IPOF right now, but I really like this one because so often we hate option buying in general. But the reason we hate that is because so often people target near-term expiry options, which decay so quickly. People buy them out of the money, which decays even quicker, meaning that, if the stock doesn't move in your direction, it's going to expire completely worthless and you're going to lose 100% of your investment. So to address point 1, this expires in September. This is a little bit longer term. And to address point 2, if the stock doesn't move between now and September, these are going to be worth 20. So we'll lose 50% of that upfront investment as opposed to calling it a total loss of $1,000. But again, the upside potential here is huge. If it goes to 18, like we mentioned, those are going to be worth $8 a contract. That'll be almost a $20,000 gain on those. But you might be saying, what the hell is this thing? Is this thing going to go to 18? Let's take a look back at the 180-day chart. So IPOF, is a SPAC. And if I go back even further, we know a lot about how SPACs trade. They trade right around net asset value for a long time. and then all of a sudden there's some rumor or something about what company that they're going to be taking public, and then the stock shoots up. And as we can see with this one, I don't remember what rumors were swirling between January and March, but even the rumors alone were enough to get this thing in the $14, $15, $16 range. And if we get back into that $14, $15, $16 range, these are going to be worth four, five, or six a piece, meaning we're going to make between $8,000 and $14,000 on this trade, just if we can get back up to these levels by September. Am I saying that's going to happen? Absolutely not. But I like the way it sets up in terms of quote unquote betting on it, because we've got very little downside here. It's a SPAC. It's not going to drop below 10 really, because that's the net asset value of the stock. And if they turn a really nice deal and the thing shoots right back up, we're going to be looking very, because as long as this thing just gets back above 10.4 at some point, it's going to be a profitable position. And that line is down here. There we go, 10.43 even. So even if it returns to where it was in April, where it was just, hovering around this $11 range, that's still going to be a play. Oops, that's not the sell that I want to edit. Even if it gets back to $11 and just hovers in that range for any reason at all over the next couple months, not 11, it'll be worth $1, and we'll make $1,500 off it. That's a nice 2x. It's over a 2x return on that play. So we are perfectly happy to hold this with our very first option buying play of, I think, the history since we've been tracking our plays. So we were super excited to have that one this week. I love the idea that I could wake up tomorrow morning and something crazy's happened and it's up to 14 or 15, and I've made $10,000 overnight on a play like this. So having that possibility after, a lot of the plays we have are very defined gain, defined risk. So we're just very disciplined in our approach to that. It's nice having one slightly undisciplined play, but is one that is still based upon sound investing principles that we could rely on for some huge potential upside if anything gets crazy in the near future. Last I heard, they were thinking about taking Equinox public, which is that large gym chain. I think they're pretty big in a lot of major U.S. cities. Don't know how that would shake out as far as excitement is concerned, but any sort of fireworks, any sort of rumors at all are enough to bump this thing back up to this 11 or 12 level, and at that point it would be a very profitable play. So that is that's the idea that we had behind that one. Moving on to the next one, we're going to go to MU and PLTR, and those were courtesy of who were those courtesy of? Let me get back up in the chat. Of KB in the YouTube chat. So shout out to KB. Let's take a look at MU Micron. I think we looked at this one last week because they had earnings coming up, and they reported their earnings. I remember this one pretty well. Nothing really happened until the morning after their earnings, where it dropped off the face of the earth. Yeah, there you see it. They reported earnings, shot around a bunch, didn't really move too much, but right after the bell rang on July 1st, last Thursday morning, it dropped off the face of the earth down to about the $80 level. Friday dropped a little further. Let's back it up to the 180 day to see if we could find some areas of support and resistance. 80, 79 definitely looks like an area of support, and that was demonstrated by where it's starting to start. Implied volatility, as we talk about so often with earnings related events, it dropped off the face of the earth after they reported earnings, and that's typical behavior, right? If we look at their past earnings, you could see IV drops off the face of the earth. See it again right here. There's a decent drop off in IV, but how does that bode for the? Let's take a look. Knowing what we know from what we just looked at the chart, I mean, very, very low volatility expected this week for Micron. This number right here is the expected move, meaning that they expect it to move either up or down, about 42, 43 cents this week, which is a tiny, tiny, tiny move. So with that in mind, we could plot, okay, we know 79 to 80 is this level of support. The way that the options are priced suggests that they expect a 43-cent move, which would only really take you down here. So maybe a 79 strike would be the way to go if you want to go on a week-to-week basis. Those would, those would set you up with a 75% ROR on a week-to-week basis, which again is not bad. So often people get caught up in, I need to get 4, 5, 6% a week. 1% ROR is perfectly respectable, and it's going to get you in the long term exactly where you want to be. More importantly, though, let's take a little bit of a look. I know we did this last week. I don't remember what the outcome was, but at our margin privileges, fully cash secured, it would be 78.42. But the buying power effect is very, very interesting here because it only requires 14.89 of collateral to sell these 79 strike puts on the week. So normally we would have that $58 of profit divided by 78.42 max loss means there you go, you get a 0.73% return. You see it pretty much calculated right there, 7.75% return on risk. But if you get a $58 profit divided by the buying power effect, the required collateral of about $1,500 to $14.89, you're now looking at a 3.8, basically 4% return on a weekly basis. And that is an enormous, enormous, enormous number. Your break even on here is going to be the strike price minus the premium. So 79 minus 0.59, which is going to be what, 78.41 roughly. So that'll put you right here with the break even price. And that is a price that it hasn't traded at. Let's see. We're going to have to back up. Okay. Traded there in the last 20 days. It absolutely has. But yeah, as we can see, it bounced off this level again a little bit back in the beginning of June. It does scare me a little bit that it broke through here relatively easily to that 75 level. But maybe we could zoom out a little bit further. I think, yeah, worst case scenario, at least in the short term, is that 75 level. We can see it bounce off of it right there in June 21st, May 18th, May 12th, and then all the way back in January 11th. I like the idea right there of maybe starting to get in here and accumulate a little bit of MU and take advantage of, even though implied volatility has dropped on us a little bit, or a decent bit, quite honestly, you could still get some decent week-to-week premiums as illustrated by the ROR, and if you use a little bit of leverage there, the ROC that you could be getting on a week-to-week basis is very, very, very nice. It's down 20 cents after hours, so these might look a little bit better come market open tomorrow morning. That is something that remains to be seen, so we'll have to hold tight on that one and see how it turns out. But yeah, I really like the idea of MU on a week-to-week basis if you've got the capacity to use a little bit of that margin, or even if you want to sell it fully cash secured and let that thing sit. Nothing wrong with 0.75% a week, but if you do use margin, as always, just careful to you just be mindful of the fact that, if I were assigned on this, how big of a position dollar-wise it would be in your account. And that takes us to PLTR, which has had a pretty nasty downturn. It got up to about 27.50 before pretty much nosediving on the back end of last week. If we take a look at the 20-day, I think that might be a better illustration. Yeah, pretty much 27.50 on the dot back on June 28th, and quickly pulled back to the 24.49 level, which if we go back to that monthly chart, this was the monthly chart, the 180-day chart, 25, what's this line drawn out right here? This line's drawn at 23.74, which is acted as support if we look historically, right? It's bounced decently in line with some of these. It's tough to draw support on this one other than, 21.46 looks like a pretty clear-cut line of support with bounces here, and with this little candle wick. But 24.50, not a bad area to get back in, especially knowing that it could run back to 27.5 and you'd have some really nice potential upside in the near term. Not a bad stock right there in the whole big data industry. A lot of people speculate they'll be worth a lot 4 or 5 years down the road, so not a bad time to be taking advantage of some implied volatility increases, even though compared historically to what implied volatility on this thing has been, this is pretty much nothing. But let's take a look at what we've got on a week-to-week basis. We've got I really like this, honestly, 1.59% at 24, which we know 24 is already out of the money. The expected move on it is 71 cents, which will put it down to about 23.70, and that would be almost right where the break-even price on these 24 strike puts are. If you wanted to get a little bit more conservative on that, you could get that percentage ROR down from 1.6 to 0.99, basically 1% a week, by selling the 23.5s, which would give you a break-even about 23.2, which is right around here. So that's not too bad. I think anything below this 23.74 level, which is where we drew, it's coincidentally the line we already had drawn on here is support. It's dead on the low end of the expected move range, and it is pretty much dead on your break-even price right around here. So that's kind of funny that those three numbers are pulled. I do like the idea of maybe 24 if you want to be a little more conservative, 23.5. Those both have really nice RORs for the next 4 days. And again, we're going to take a little peek at the leverage privileges that this one potentially grants us. Yeah, decent leverage here, right? So normally it would be 37 divided by 2363. You'd have a 1.56% return on risk. That's what we see illustrated right here. But that same $37 return divided by 933, which is required right here, sets you up with the 4% weekly return. So really similar value to those MU options that we were looking at a little bit earlier. So yeah, honestly, I like the idea on that one too. For the longest time, the premium had dried up and a little bit overextended. Nothing really looked that good on it. I think now that it's pulling back to this 25 range, you can start selling some options that'll get you a break even right around this first level of support on a week-to-week basis. I think that's a decent time to be jumping back into those. So I'm a fan of that play. Let's see. What do we have up? What do we have up next? MUPLCR. Prinsmeister in the Twitch chat. There we go. IVR. We're going to take a look at IVR. I think this is another one of those cheaper selling stocks. 370. Let's take a look at the chart. It's fallen off the face of the earth. And I think we did look at this before and said that somewhere below the $4 level is what we would want to be looking at to get on this. I was curious if this was a sympathy move with AHG, but that doesn't look to be the case. There was a slight drop off Friday after hours, but nothing too crazy. But looking at the 20-day, you're getting right back to a level where you might start to find a little bit of support. Let me back up to the 180. So this area right around here, right where it bottomed out at the beginning of June, right around 330. It stalled out around that area between November and December, and even January of this year a little bit. So 330, 340, 350 does not seem to be a bad place to get in. But Prinsmeister, oh no, he said he got caught holding it when it fell down. So we are going to find a way to get you out of that. You're going to be just fine. Hopefully, like we talked about earlier, you only allocated a little bit of money to it and didn't go all in off the bat. Kind of want to take a look at these. Okay, great news here. Two good points here. The first is that there are weekly options, so you could have some decent flexibility and manage that pretty well. And the second great thing here is that the strikes of the options, unlike looking at earlier where you see the strikes 2.5, 5, 750, $2.50 increments, with IVR, what we've got are 50-cent increments, which allow for a lot more flexibility. Surprisingly though, there's not a ton of option premium, so you may have to go out a week or two to try to get anything meaningful on these. Any leverage right here? It looks like you can get a little bit of leverage. That was more of a personal curiosity, but if you're stuck in these, I don't know what your Prinsmeister, feel free if you're comfortable sharing what your break-even price is on these. But I think at least in the short term, 330, 340, unless the company comes out with some crazy news, is probably a decent place that you could hold on to it and play it down from in the meantime. So there might be some more short-term downside into this area as we approach the week. But at the same time, I mean, sometimes off big drops like this, it could spike right back up to 4, and you'll be like, oh, whoops, I don't know why I didn't do something sooner. So really 50-50 about what you decide to do there. I think if you did want to be as conservative as possible, right, we see that implied volatility has been falling down. Historically, it's around this level, so it's slightly from where it has spent most of 2021. Or I guess I should say most of the time between June and the end of March. Yeah, premium isn't that great on it for how big of a move, like Tashio so eloquently put in the Twitch chat. So Prinsmeister break even around 375, 380. That is not a bad place to be at all. I think if I were you right now, assuming that you're in 50%, right, what you would do is start the strangle with July 16th, 3.5 strike puts. If you do a perfect ratio, 1-to-1 strike, you could sell one cash secured put on that to complete the strangle. That would get you this is a direct reduction of your break-even price, so that would take you to around the 365, 370. Excuse me, take you to around the 370 range, so that wouldn't be too bad for 2 weeks of work. And then, it looks like there's a lot of upside potential on this one. So one, you could see a bounce, or two, the amount of premium that you're getting from the calls. I don't know if you currently have them covered, but again, that would lower your basis even further. So it looks like looking 1-2 weeks out at a time, you'll be able to knock 6, 7 plus 7 or 8. You'll be able to knock about 15 cents off your break-even price per 2-week period. I mean, if you wanted to get super conservative and look out to like August, you could knock 40 cents off that break-even price and get to a longer-term basis of roughly, I don't know, 330, which gets you right at that level of support. So if you wanted to be super conservative and do that, that's an option too. But we like to take advantage of those shorter-term expiries and get something, maybe not on a week-to-week basis because that premium looks a little bit low, but maybe on a 2-week basis that looks a little bit better. So that would be my 2 cents on IVR. We've got a question from Rainmaker 2021 in the Twitch chat. What are thoughts on Riot 33.3250 credit spread at 37-cent credit? And Prinsmeister, to address that quick comment about waiting till Tuesday. I don't know if any of your stuff's covered right now, but a lot of the time playing the waiting game is a little bit dangerous because what we see in front of us, right, we know we can get your break even down to 360, 370 if you recover with the 4 and the 3.5. What we don't know is if, you wait for the market to open Tuesday and all of a sudden this thing drops to 330 and now you've got less premium on the calls and less premium on the puts that you can sell. So that's when you start to run into, not less premium on the puts, but you'll get less premium on the calls and less advantageous premium on the puts, I should say, relative to your position. So I would go in, take what you see in front of you and move forward there. But getting back to the question from Rainmaker 2021 in the chat about a Riot credit spread, 33, let's see. So I'm assuming that's going to be a put credit spread on that. Riot trading at 36.23. Put credit spread 33.3250. Assuming that's a 33 short leg. Let's take a look at the value prop right there. Riot vertical. I don't know what expiry you were looking at there, Rainmaker, but I think at least in the near term, 32.5, yeah, it would be tough to get a 37-cent credit near term on a 33.32.5 spread. Let's see if we could find where we would go out to find that kind of a credit. Let's see. Maybe not here. I don't know. I think if you were able to get a 37-cent credit, great idea right there. Unless you're thinking about a call credit spread and you're trying to play it back down. Maybe that's what we were going for with that comment. Tough here. The spread's so wide in the money on something like this. So if that's what you're going for, I'd maybe stay away from that. But yeah, I'm not seeing a 37-cent credit on a 32.5, 33 credit spread for Riot. But if you were going far enough out where you were able to find something like that, I'd be a little bit hesitant. It's nice that this stock has leveled off a little bit. Credit spreads are good on this one because they protect your downside in case it really, really tanks. And the stock that previously traded for such a low amount has run up this much and is then coming back is a decent candidate to be something like that where it pulls back pretty severely. So I think maybe I would stay away from that one. 37-cent credit, even though we can't see it on here. I would let that thing rip because that is quite the payout for the potential max loss right there. So we're a little over an hour here. I think we're gonna want to wrap this up by maybe just taking a quick look at our scan. There really aren't any options coming up, so it's tough to really do anything there. Probably not a lot of great opportunities, but we could run our high ROR put scan here in the entire market. Just see what's going on as we sort by ROR. Made that into one word. Whoops. OCGN 8-strike put is enormous right now as far as premium's concerned. OCGN, what's going on with this one? I wonder if they have some sort of news coming up. So it looks like they had some sort of news on the 2nd. I don't know if it came after. It looks like it did come after hours. That would explain why. Because this was previously out of the money, but now it is in the money. So we could ignore that one. That's kind of a false result based on after movement for our scan. But SPCE, I can tell you off the bat, this is not one I would want to play. I think this one eventually is going to find a home in the third range. So if you could be patient and wait for this to fall back right around 30 to 35, that's a much spot to get in. I know Richard Branson, they announced he is going to be on one of their flights pretty soon, so could see a lot of volatility from that. We've already seen an insane amount of volatility on the stock itself so far, so option premiums are wild right now. So if you are an option seller, it is beautiful what you are looking at right here. But again, this is one of those things where it could drop off the face of the earth if anything goes wrong with the flight, and you could see the 20s, within the month if anything went terribly wrong. So that's a little bit risky. One thing I do think is interesting with SPCE to talk about are those longer dated puts that we talk about, right? So if you got to January 2022, you could set yourself up with the play. I want to see all the strikes here, where if you sell, I don't know, a 20, even a 15 strike put, you're able to get a 7.8% return in, that would be 6 months, but as long as it stays above 15, which is here, which it has only been below once, and it was very briefly below that. Fact of the matter is you're going to get what's basically a free 8% return. But what's interesting about this is when we have our conversation about leverage, right? So it is an 8% return on risk if you sell those fully cash secured. So if we sold it for $1.06, right? This is where the margin game gets interesting, and you could really take advantage of it for stuff like this, because implied volatility is so high right now, as demonstrated by, let me X this out really quickly. You can see implied volatility is through the roof, and not only does that increase the premium for options that are right around the money, like we talked about earlier with CERE, ALEC, and ASTS, that also increases premiums on puts that are very far out of the money, and you could have a very similar setup here where, as long as it doesn't drop below 15 by January 21st of next year, you are going to be living life. Now, it looks like a 7.8% return on risk, which, you might not be getting out of bed for over a 6-month period. But the excitement in this comes from the leverage that selling deep out of the money and selling far away will get you. So you could see normally we're going to do the calculation that we've done it the whole night, right? You get $106 in max profit off of $13.94 of full collateral if you wanted to sell it fully cash secured to get that ROR number. And as we can see, 7.6% return. That's what they indicated in the column that we were looking at on Thinkorswim. But that $106 return, if you want to use margin privileges, only requires $150 of buying power. So it's now, being divided by 150, meaning it's now a 70.6% return on capital over a 6-month period. And again, you're getting this 70.6% return just as long as the stock stays above 15 right here. So it's not even like, over the next 6 months, if this thing pulls back to support at like the 35 or the 27 or even the 20 level, like I'm in trouble. Like, no. As long as this thing stays above 15 period over the next 6 months, you're going to make a 70% return on capital. So I think this is an interesting one to keep an eye on if you have a little bit of capital in the back of your portfolio. If you've got, $3 or $4 grand you want to throw at a play like this, not the worst thing in the world, because if you threw $4,000 and just let it sit on a play with 70% return on capital, you're going to get $2,800 that'll be there waiting for you come January, just for having the stock stay above this level. And again, this isn't an all or nothing play with these cash secured puts. If it drops down below 15, you get assignment of stock at, a $14 basis, which I'm sure would be decently manageable provided the company hasn't just folded come January. So that is a very interesting play and highlights why we like to look at some of these longer dated, deeper out of the money puts. UWMC was also an example of one we sold 7.5 strike puts on for December, because those are going for, sold 7.5 strike for December. Those are going for $1.25 a piece. Normally it would be $6,300 to fully cash secure those, but now it's only $2,600, and that's just under a 50% return on collateral. If you wanted to go to January, line up your expiries and go down to 6 and get 60 cents, that is only off $1,200 of collateral. That's over a 50% return on collateral, but that illustrates how going further out of the money, further expiry, and using some of those margin privileges can set you up some pretty nice opportunities. And that's why when you see plays like UWMC December 7.5 strike puts sneak into our weekly profit tracker, that's where they're coming from. But with that said, we're coming up on an hour and a half, so we are going to cut it off there. That hopefully was a decent look at a few stocks that you guys wanted to look at, a decent recap of what we're holding on to and what our plan is going forward with what we're holding on to, and I think that's pretty important right there. So hopefully that was informative, because I know a lot of you guys are holding similar positions, but long story short, it sucks that a couple things have moved against us, but as is always the case, we're going to be okay because we've properly managed our risk up front. We know how to use our strategies to lower our break-even price and continue to lower our break-even price throughout the life of the trade. And eventually, we could lower our break-even price faster than the stock can lower the price. So hopefully one day they will catch up to each other and we'll break even on a trade. But, in general, what happened last week sucks. I'm not terribly worried about what's coming up in the upcoming week because I'm confident in our strategy. Everything in general will be okay. Every time I get a little bit worried, I take a look at the previous plays we made. I take a look at our chart, our performance against the S&P 500, and I feel a little bit more peace of mind. And even if you really want to get crazy, you could throw max losses into your positions to say, okay, if this stock just disappeared tomorrow, this is what would happen to us. If AHT went to zero tomorrow, this is what would happen to us. And again, the two that we were worried about, right, AHT and GTT, if these stocks literally disappeared off the face of the earth tomorrow and we realized max loss, we're still only losing less than 4% of our portfolio. So that is not too bad of a thing. But again, want to thank all of you guys who have tuned in tonight and have been tuning in every night on the weekends for our trade idea streams. It's always nice having people in the chat. It looks like the numbers in the chat, or at least the numbers who are watching, have gone up a little bit, so we'll try to work on that a little bit. Hopefully, get those numbers pumped up a bit. The goal, the more the merrier in here. I feel like the more the chat gets going, the better it gets because we get some back and forth from everyone. We get some new perspectives, some new stocks to look at. A lot of these things, admittedly, I keep an eye on the market, yeah, but so many of the plays we make come from group ideas, like things like ALEC, CERE. Those I called out, but we got those from a member of our Discord server. So always super appreciative of everyone in the server who is able to, throw ideas in, help workshop different ideas, say, hey, I'm thinking about this. What's the best way to play this? Because, it helps you guys, but it helps me just as much because sometimes when I'm thinking through these things and saying, okay, this is what I would recommend, I get to the point where I say, okay, what I recommend would be an awesome trade. I think I might get in on this myself and make a little bit of money. And, we've seen that from some of these plays. So if you're watching this and you're not in our Discord server, definitely come join. You should be able to find the link on our Twitter account. I think we've got the link in a lot of the descriptions for our YouTube videos if that's where you're watching as well. I think we've got the link in our Twitch channel. So hopefully there are enough avenues for you guys to find it if you are not in and you would like to join. Because again, we do these things on the weekends. There's only so much that we could see headed into the week. We could come up with the plan, and we could be 10 to 15 minutes into trading tomorrow morning, and all of a sudden something crazy's happened in the market. The whole plan has gone out the window. So that's the importance of having that Discord server where we can keep everyone on the same page live. We could call out our trade ideas. We can call out our trades. Stay on the same page and, move forward together and adapt and adjust and take advantage of these big moves that happen during the week. Because so often, I think very rarely do we Monday mornings, do we open it up, make all of our trades for the week, close out, and check back Friday. Now, with the strategy we run, that's something you could definitely do, but so much opportunity happens during the week, and having those alerts on from us and being able to see what's going on from other people in the chat is super, super, super helpful for when you can't afford to be glued to a screen 24/7, because quite honestly, the amount of actual trading we do every week, takes less than 5 or 10 minutes. It's super short, the amount of time of trades. The value comes from, finding entries. And even if you mess up an entry, right, the premium that we get on these options that we sell gives us a really nice cushion. So if you mess an entry up, no skin off our back. We'll lower our break-even price again next week and keep it going. And even if you do mess up an entry and the stock goes up, you still get max profit and things are going to be okay. But that was my little spiel, I guess, about why we want people in the Discord. We are looking at rolling out an HT Premium or an HT VIP. I don't know what I want to call it yet, but we're going to have that service coming up soon. I'm working on pulling the website together and finally getting that up and functioning. I could pop over to that really quickly to share. But here is the website in all of its glory, right? We've Got a tab on here to live track our performance if you're too lazy to click into our Google Sheet, which should load, right? We've got a live updating chart where you can see the different data points that plot our performance against the S&P 500. We've got a chart that shows our win rate by strategy on here. Again, this also updates live. So we've also added some education stuff, right? If you want to learn about credit spreads, the HT wheel, we've got all that in here. We've got write-ups in there with links to YouTube videos, and hopefully that'll be super helpful. All this stuff that you see in here as it exists right now is going to stay completely free. What we're going to be adding are, outside of HT wheel and credit spreads, some of the opportunities, things we talk about, like the 10-day play for earnings. We talk about new options listings sometimes. We talk about even that strategy that we teased a little bit at the front end of the stream tonight, where we target the high IV plays. Stuff like that, I think, is what would be included in those in the premium package. Access to our trades and getting things like text message alerts, so you don't need to be glued to your screen to know when we're getting in and out of trades. You can get a text to your phone. You might say, okay, I'll join this trade, I'll adjust my position, whatever. So like many other traders, when people are just on their screens all day hovering over charts looking for perfect entries and exits, you'll be able to get alerts from us to let you know exactly when we're in and out of plays, so you don't have to worry too much about that. But again, we've got our blog here. We've gotten back in the habit of sharing our high premium puts, and we're going to have some other scanning type things in there for you guys to be able to quickly read and access from this. But the idea and the thing that we want to emphasize is we're trying to be as transparent as possible, I guess, because I don't want it to seem like a super slimeball move where the rug gets pulled one day. So the important point to emphasize from us is that everything that you've got, with the exception of the trade alerts, are going to exist as they currently are. We're still going to have the education. We're still going to have the YouTube videos. We're still going to have everything in the Discord. We're going to have our weekly streams. So all of that is not going to change. But for the HT Premium, HT VIP, I guess whatever we call it, we're going to be looking at adding more things to the package that we already offer. So the experience as it is right now hopefully will remain unchanged. We really appreciate and love the community that we've been able to build on the Discord. Appreciate everyone who has been tuning into the streams every week. That's something that we think has been awesome. So that's something that we are not going to do anything to mess up at all, but definitely want to keep everyone in the loop, be fully transparent about any things like this that we're trying to put together and hopefully push forward. So if anyone has any feedback, input, suggestions, even for stuff like that we could offer in an HT Premium package, feel free to let us know in the Discord server. But those are our plans for that. So in the next few weeks, that'll be something that we're looking to roll out. But again, thank you again for everyone who has joined us tonight on the stream. We always appreciate everyone who tunes in. Hopefully our recap next week will not begin with the screen that looks like this, but we'll begin with the screen where these cells are highlighted green. So we are going to end it the way that we always end it, saying this has been the Hourglass Trader, where as time passes, we make money. Thank you guys so much for watching, and hopefully we will see you in the Discord server this week and on the stream again next week. Hope you guys have